Good morning and a very warm welcome to this session on brand valuation and how it affects the value. And today we have the distinguished panel of CA Anil Bhandari, the chairman of the Valuation Standard Board, CA MP Vijay Kumar, the vice chair of the Valuation Standard Board, my colleague in the board, Sarika Singhal, and our distinguished speaker for today, Ameya Kapnadak. Well, let me start this session by making the reference to the concept of a product. What is a product? Meant to serve a existing need or a latent need, and the product development to be layering in 5 concentric layers of core benefit to serve any basic purpose for which the product was intended. Now, moving on from there arises the generic form of product from the need perspective to the augmented product providing additional benefits, potential product for increasing the retention span and creating niche for itself. And when this is related to the product life cycle, which the marketing guru Philip Kotler in 60 stated, that it would broadly travel through stages of nascence, growth, stagnation, and decline. And when this is read along with another strategy model which came in 80s by Michael Porter, 5 forces of competitive position. We have the components of competition, threat of substitution, and new entrants, which are all related to the product and the conception of the brand. Any business would hover around creating and dealing with the products or services, and which gives them a distinctive brand name. And these brand names as intellectual property are distinctive with aura and halo of the business around them, create an economic monetary value which distinguishes it from competition, and create a lifespan. One would say, why all this ado around a brand name? If we look at the history of trade disputes amongst nations as part of public international law, whether it is relating to European Union classic cases on wineries, chocolates, uh, cases in the Asia region relating to basmati rice, and many such other products which have gathered much of the traction, is because of the legal and economic consequences, and a brand beyond the name in isolation would also have many a times the geographical indicators or the trademarks which gives it a distinctive and identifiable status and carries a legal protection. And now we come to the today's context, what all is brand evaluation, what it would mean, and the challenges it throws in. Now, any financial information which the corporates capture in, it monetizes the brick and mortar business component, and the IP of the brand and other intangibles which are distinctive for the business concern remain unvalued. Need for brand evaluation is going to arise when these brands may be required to be valued in scenarios of business combinations or restructuring, corporate valuations, fundraising, licensing, legal disputes. And the challenge is also that while the brand would remain an intangible assets, there are identifiable intangible assets like patents, copyrights, but there are other intangibles which are not identified, like goodwill, reputation, strength of the horizontal and vertical networks, but they all have a bearing on the brand itself. Now, like any valuation exercise, the challenge remains in identifying the purpose around the valuation, for whom it is being done, of course, the date, and most importantly, the valuation method. While the existing evidence literature shows use of cost-based, historical cost and replacement cost methods, market capitalization less net tangible assets, comparable market valuations and economic benefit method, value coming out of a difference between price to sales ratio of branded company and the unbranded company multiplied by the company's sales of very iconic Kellogg and Coca-Cola valuation in late 90s, followed by interbrand method of differential earnings between the branded company and the unbranded company multiplied by a multiple. Now, all this is important because brand would lead a corporation to sell at a higher price, maybe because of the strength gained in vertical integration through new distribution channels, adding new countries, new products, new format. So, brand, yes, it is important. And like the shipping industry, the oldest form of what you call a organized market, the brand valuation also goes by the concept what the market is willing to pay. But beyond this, how do we address this on legal, economic, or accounting issues? And we come to a near value which gives the best trade-off. And while there are many definitions of a brand, one I picked up is the brand a product's additional value for its customers. Compared with that, would be of the value of another identical product, substitutable but without the brand. How do we crack this paradox of assumptions and judgments to bring any accurate value? I think we have a very learned speaker today, Ameya Kapnadak, who is the Chief Growth Officer of Interbrand India, and he was responsible for establishing ICICI brand in very distinguished markets of US, Canada, Middle East, and Sri Lanka. Of course, a very heterogeneous sort of markets. And then apart from the banking finance, he has been engaged with the auto brands like Volkswagen, Renault, Nissan, Mahindra, Ashok Leyland, Hero, Bajaj Auto, technology sector, including Infosys and Capgemini, FMGG, Unilever and Godrej, and including the fashion industry, Sabyasachi and Van Heusen. So I think we have a excellent speaker today, and I think we'll have the demystification around the brand valuation concept. So with these words, I welcome the panel once again. And with these words, may I hand it over to you, CNL Bhandariji, to carry forward the process.
Well, thank you, Rakeshji. Thank you so much. Sometimes when you speak, Rakeshji, I feel like I am either in a Harvard classroom or a Purdue classroom, because with the simplicity and the complexity both that you put together is sometimes very, very interesting. So thank you for setting the context right and also giving a very nice overview in terms of the brand and the potential and so on and so forth. So of course, while you were speaking about those great names like Philip Kotler and all, I started to think about brands like Harry Potter and Game of Thrones. And then in my mind, suddenly something rushed to say, hey, what happens when you use a brand for a different product? Does the value still continue or not? For example, what happens if I sell a Kingfisher pen, for example? So is a brand really a brand, or is a brand always a brand when closely connected to a product, and so on and so forth? So there are several questions rushing to the mind at this point in time. I'm sure with my friend and colleague and Vice Chairman MP Vijay Kumar, we would have a fantastic run in this session today. So a very warm welcome to you, Amaya. Thank you for taking out time. I'm sure this is going to be a very engaging, engrossing, as well as our members and registered valuers who come here on this program. While there are thousands in numbers, they also ask some very interesting questions. So I'm sure you will be flooded with a lot of questions today, because brand is always a very, very complex subject. So MPV, on to you. Please take this forward.
Thank you, Anil, and hearty welcome, Ameya. Thanks for accepting our invite to be here. Very impressed with your credentials and your work experience. I'm sure the participants are going to get significant value for the time they would listen to you. And thanks, Rakesh, for that wonderful introduction of the topic. And I endorse every word of what Anil said about the way you spoke about the entire topic. So thank you for that. And I'm really proud of the talent in ICAI. I should put it that way. And you have been a tall leader within ICAI. So thank you for that, Rakesh.
Thank you. It's a team which works under a common theme of providing value.
Appreciate, Rakesh. Appreciate. So Ameya, say brand, as all of us know, is a promise. It's a promise. Before we get into valuation models and how do we value a brand, can you articulate to set the tone for the discussion? How does somebody explain value of a brand? How do you attribute value to a brand?
Well, first off, thank you for having me over. And I'm honored to be speaking to all of you today. I just hope I can do justice to all the great expectations that are being set. Full disclosure, right at the beginning, I am not a CA myself. So I kind of broad addressing such an august gathering. But I do think I know a little bit about brands, so I will get into some of those details. Vijayji, I think you'll find a lot of different definitions of a brand, right? Some say it's a promise, some might say it's the halo, some might say, you know what, it's actually the sum total that you can earn from the royalties when you
Amay, I think your
because
Amay,
that's
I think
how
your internet connection looks to be slightly low, and your voice is cracking. So,
okay,
yeah, if you could.
Maybe if I can just move a little closer
Yeah,
to
yeah.
the. Is a little better?
Yeah.
Am I audible?
Yes, you are audible better, but we can't see you.
Okay.
Yeah, we can see you now.
Just
all right.
give me 1 second. I'm going to try and move to another. Do you want me to let me move to another room?
Yeah, sure.
Just give me 30 seconds. Yeah.
Or you may want to try all the brands in telecommunication, Airtel, Jio, Idea. Something I'm sure would work. So what's your view, MPV? If you attach a brand to a different product, does the brand still remain a brand? Can Harry Potter sell?
Not really. It's a brand basically is a promise about what you can deliver, in my view.
Right.
So if you
there we have Amaya back. So,
let's listen to him.
We were just trying to kill some time, Amaya. Back to you, Amaya.
Hello.
Amaya?
Is this better?
Yeah, it's better. Let's move on, and if there's a difficulty, we'll let you know. So Anil, what I was saying is brand basically is a promise. And if it's a promise which people expect can be delivered, then it works. So in the context of a Kingfisher brand, whether it would work for a retail product like a pen, it's a question mark. Would customers believe they can do? I think that's where it boils down to.
So I mean, I was only coming from a perspective that does the value stick to only that brand, or does the value very closely stick to the brand and the product put together? And of course, there are brands like the Tata Group, which actually stands and denotes, of course, a little higher form of promise, that anything and everything that they do would converge into a good product or a good service.
Yeah, but sometimes that also doesn't work. They also have their own examples of inability to ensure that the promise is delivered.
Correct.
And as you told, Anil, there are multiple examples. Some cases they have been successful, some not successful.
Yeah, May, welcome back. You can.
Can I?
Oh, you're
am
perfect.
I audible now?
Perfect.
Perfect. I've moved into another room. Well, so apologies for that.
No, please, we all understand.
Interruption. But like I was saying, I like to think of brands as an interface between the business and its customers. So because it is the brand through which the customer interacts with you as the business owner, and it is the brand that gives the product that meaning. And those interfaces become increasingly important. To your question, the point that you were making earlier, Anandji, because over time, what we find is brands begin to stand for a set of values. And those values can get extended across product categories. So let me give you an example and why we make this sort of profound statement that brands today are replacing categories themselves, right? So let's take a brand like Red Bull. The base product that you associate Red Bull with is that energy drink. But is Red Bull really an energy drink brand? No, it's not, because Red Bull stands for energy. And therefore, Red Bull has not one, but two Formula One racing teams. So there is a Toro Rosso and there is Red Bull Racing, and they're all equally Red Bull, right? And that's why Red Bull can do some of the things that it does. Whether it's motocross, it has teams which compete in Formula racing, so on and so forth. So as long as the set of values that that brand stands for and the promise that it makes its customers, and that's the point that was being made earlier, that it is a promise. As long as that's that the core that it stands for is constant, I believe a brand can actually span categories. So to take that example, Kingfisher pens, why not? If there was a pen that was uniquely Kingfisher, you could have Kingfisher pens. Unfortunately, the airline took on the persona of a beer brand, and that's when things started going wrong. It actually ended up sinking a beautiful brand. So yeah, that's how I would look at what brands are.
MPV, you're on mute. MPV, you're on mute.
Ameya, in your experience, what are the various factors which actually contribute to a value of a brand?
I'll take the easy way out and say lots. that's my classic consultant's answer. But on a serious note, I'd say, well, when we do our valuations, there is three broad factors that we look at, or three modules that we look at. One is obviously the finances, the financial factor, because to be able to value a brand, that brand has to be making profits. It has to be making you money, even if it's not immediate, at least in the future. The expectation is that there will be profit. So every valuation is built on the basis of a financial forecast, so to speak. The second big thing is what we like to call a role of brand. So the simple way to explain a role of brand is that particular purchase that the consumer is making more an emotional one or more a rational one? And you will find categories where the role of brand itself is inherently low, and the purchase tends to be a lot more rational. So let me give you an example. Let's just say you're driving down in a car, you run out of fuel and you want to buy fuel. Now, you wouldn't think twice about which fuel station you went into, as long as you're reasonably certain that the quality of petrol or diesel that you're filling in your car is consistent and it's the same price. Same is the case with electricity, right? So you don't care who supplies power to your home as long as you're assured 24/7 power and a certain price that's commonly paid, right? So these categories themselves are what we call low role of brand categories. So the comparison between two becomes fairly simple. It's not an emotional decision. Let's just put it that way. Whereas now let's look at a category like fashion. So when you, let's just say, go in and I'm reminded of this video that went viral of this lady who was flabbergasted that her daughter chose to pay 35,000 rupees for a Gucci belt. And she said, but this looks like BPS school wala belt. So So if you, let's say, go and buy a Gucci bag or a Louis Vuitton bag, you wouldn't be buying it for the quality of the leather or the workmanship. You buy it because it's a Gucci, because it says something about you. In other words, it's a highly emotional purchase, and therefore the role of brand is much higher in that category. So typically, when you look at energy as a category, the role of brand could be as low as 15, 16%, whereas when it comes to luxury, the role of brand can go as high as 70, 75%, which means 75% of the purchase is directed by the brand itself. Right? So that's the second big factor. What kind of a market is the brand operating in? Is it a high role of brand, or is it a low role of brand? And the third factor really is the brand's relative strength vis-a-vis its competition. So within that set of competition, is it an extremely strong brand? And we have ways of measuring that. There are 10 factors that we look at, which come up with a composite index, a score out of 100. And some of the world's biggest brands have a score of, let's say, 80, 85 on 100, right? So that's the third factor in terms of how strong is the brand as opposed to the competition. And these three together come up with or influence the value that the brand gives. And incidentally, each of them has a business context to it. The first financial module really is about the revenues and the profits. Role of brand correlates directly with the premium that the brand can charge, and brand strength correlates directly with the risk. So the higher the brand strength, the lower is the risk of future earnings.
I couldn't agree more. So, Ameya, before we get into valuation specific questions, just to ensure we have got the conceptual understanding right, can you articulate for us the difference between a brand value and brand equity? Are they interchangeable terms? Are they quite distinct terms? And if so, what are they?
So they're used interchangeably. However, I'd say brand equity is really what the brand stands for and all that it encompasses. The best example I would probably think of is brand strength. So if a brand has high equity, it possibly is also a stronger brand as compared to its competition. Brand value, on the other hand, is monetary. It is economic. So maybe one way to link it is that brand equity leads to creation of brand value. The two, in my mind, are not interchangeable. Equity comes first, and value becomes a result of that.
Okay. So brand value is basically the perceived value of the entire brand, and brand equity perceived value, and brand value is the financial value you attribute to it. That's a very nice explanation. Thanks a lot for that, Ameya.
So Ameya, I just had a quick follow on to what you were saying earlier about fashion accessories or other brands.
Recording stopped.
So if you talk about Coach, or if you talk about Gucci or whatever, sometimes a lot of these brands are actually owned by a single
in progress.
Entity, right? And of course, a single entity having a multiple brand, of course, is not a challenge. But I'm saying the ethos of every brand is different, correct? But if you look at these brands now, for example, Gucci or all of those on the high street, and because they're owned by a single entity, somewhere I think the ethos is completely lost, except for the fact that they happen to be on high street, their showrooms happen to be in particular style, whereas the product has not too many differentiators any longer, right? So what would get into these kind of brand valuations? I mean, on a top level, what are the ingredients that would go in? Like, for example, if somebody were to ask you to value Gucci, so the money aside, the monetary terms aside, what would fundamentally get into this valuation in terms of bullet points?
So
like,
again,
yeah.
So again, I mean, let's say hypothetically, we're doing a valuation of Gucci. I would first look at the competition set, because Gucci probably does not compete with and Manish Malhotra. You know, the two are very, very different. So within that competition set, then you evaluate the Gucci brand as a brand alone based on brand strength. How strong or how weak is Gucci as compared to, let's say, a Louis Vuitton or as compared to a Burberry, because that really is the competition set. And that gets into the relative brand strength. The role of brand for each of these, although you could get into an extensive market research quantitative exercise to determine the role of brand, but you're able to estimate, saying, if you're looking at fashion, then the role of brand changes. And that's another point that I'd like to make. The role of brand is specific for a brand within an average. So if you I think Anilji is frozen, is it me? Am I audible?
I can see you.
Or is my connection gone again?
No, I can see you. You can hear me.
Okay. Great.
Yeah, I can see you.
Great. Perfect. So that's the other point I was making. So let's just say when I make the statement that the average role of brand for fashion, since we're speaking fashion, is 67%. That doesn't mean every fashion brand is 67, right? Because around that average, there is a bell curve. And the way to explain that, take another example, automotive. Now, automotive, the average role of brand is about 34%, which means another way to look at it is on an average, every $100 that an auto company earns, $35 can be attributed to the brand. But that's, again, an average. Within that auto, you have a company like Maruti, which until very recently was known for value for money. So it, as a brand, it gets associated with the more low value creating drivers. Kitna deti hai? What's the cost of, what's the maintenance cost? What's the resale value? All of that. And within that same automotive category, you have a brand like Ferrari, which has a role of brand of 76%. So each brand is different. So you would, to come back to the question that you were asking, what would go into, let's say, evaluation of a brand like Gucci? It would be the role of brand and the brand strength. Those are the two variables. And then, of course, it gets laid on to the financials, and that's how you can come to the monetary value.
No, fantastic. So anyway, we'll I think as we progress, we'll get a little deeper into this, because sometimes I am not in today's time, I'm not able to find the difference between a brand from too much difference between a brand from a product perspective. Also, for example, a BMW features with a Mercedes-Benz features with a Skoda features, and sometimes all of these companies again owned by one set of companies. So it's just one set of styling available. So what I'm saying is that differentiators are getting very blurry.
That's correct.
In terms of some top brands.
Right.
And in that scenario, how do you maintain the brand perception and a brand value? Because brand value should also be connected in my mind to brand disruption or to a product disruption, right? Kia comes in and disrupts the product suddenly, right? And every brand, of course, has a major impact on their value sold. Tesla comes in and disrupts the product life cycle in terms of monetary, the value goes down, or whatever. So anyway, we'll go through it when MPV has got some questions up his sleeve. So let's go and take that one by one. So back to you, MPV. Thank you.
No, very interesting topic. In fact, there's so much to learn about what goes into a brand and how do you build a brand, manage a brand. It's a very involved subject.
So I'm not sure, Amaya, if you're aware or not, but MPV himself is a brand in South, right? So if MPV stands at 10,000 students all across him, and of course 10,000 members as well,
absolutely.
so he carries a fantastic brand there. Anyway, sorry, MPV. Back.
So coming specific to valuation, Amaya, Rakesh also mentioned in his opening remarks. You also briefly mentioned. Valuations of brands are typically done when you have a transaction, whether it's an M&A transaction or a shareholder settlement transaction or those kind of situations. How does a valuer get to start his approach with reference to valuation of brand in these differing circumstances?
Well, so I think mean, one of the things that we do at Interbrand when somebody approaches us to say, we want to get a valuation done, the first question we ask is why. Many of the people who come, they say we're just interested in the number. So then you go a little deeper to say, is there are you looking at raising money? Are you looking at selling off? Or is it an M&A situation? But then broadly, there's.
Sorry to intervene, but if you can be a bit louder.
Yeah, Ameya, a little louder
Sorry.
would be helpful.
Little louder, please.
Okay. Is this better?
A little better.
Yes, sir.
Much better. Yeah.
Okay. So I'm saying there's a number of applications for brand value, right? It could also be like for instance, we use valuation for a business case. So to convince the management to say, if you invested so much, the potential uplift in our value is so much. And we did that in case of, there were two airlines in Latin America. One was called LAN and one was called TAM. One was from Chile and the other was, I think, from Colombia or something, and they were merging. Both very strong brands in their respective markets, both owned by mercurial family owners. And when the merger happened, there was a question, which brand do we go with? Do we go with LAN or do we go with TAM? And that's where we actually did a quantitative modeling exercise to show and to prove that the best scenario would be to create a third brand which is completely different. And that's how both brands merged their identity into the third one, which was called LATAM. And it became the region's first regional airline, so to speak, because it was no longer Chilean or it was no longer Colombian. It stood for the entire region.
Brazilian airline.
Yeah. Sorry, it was Brazil and Chile, and LATAM became the world's first Latin American airline. So you can do that for business cases. There are portfolio optimization scenarios, for instance, where you use valuation to say, if let's say there are too many offerings in my portfolio, if we were to merge these three into one, it realizes greater value. But long story short, depending upon whether it is strictly financial or it's more strategic. And when I say strategic, I mean taking decisions like, where should I focus my efforts on to build greater value for myself in the future? That to my mind is a strategic use of brand valuation. So to give you an example, I think about 4 or 5 years ago, we did a valuation for a large conglomerate, which has interests in steel, it has interests in energy, and so on and so forth. And there we were able to, through the use of valuation, prove that if you did just these three things, because what also happens in large organizations is that you tend to do too many things. I want to run this campaign, I want to run that CSR, I want to run this product development, and you end up spreading yourself too thin. So we were able to prove that, there are just these three things that you need to do. Number one, if you did this, you could see a value uplift of X. If you did this, you could see a value uplift of Y, so on and so forth. And that's how they were able to focus all their marketing effort rather than spread themselves too thin. So that's a strategic application of brand valuation, where I would perhaps spend a lot more time on the brand strength framework, because that's what is the most diagnostic part within at least Interbrand's brand valuation methodology. Whereas if it is more financial, like for instance, very recently there was a valuation done for a brand which my team did, whose purpose was to raise money they were going to a set of investors to say, this is the value of my brand, so can you invest in my company? Where the focus is a lot more, you would put in a lot more scrutiny to the financial numbers themselves. Are they making sense? Is it getting a bit too rosy? Are the assumptions that we're making correct for the future growth of this market itself, the addressable market itself? So those kind of things. And that's how I would probably look at different applications for brand value, making slight changes in the methodology itself.
Okay. So thanks, Amey. I may have 2 points. One is if it is not otherwise confidential, and if it is in the public domain, the use case which you mentioned of that steel and energy entity, if it's fine, so that the participants here can connect to what we are saying, it's fine. You could share it. The second point, Ameya, which you mentioned is the valuation of brand is very closely aligned to how you are going to strategically use it in the future. So as a valuer, as I understand from what you say, it's very important for the valuer to understand how the brand will actually be used in the future, post whatever purpose for which it is being valued. It could be for a hive-off, it could be for a merger, it could be for a family settlement, whatever. So is that understanding right?
Yes, that is correct. Your question was whether we need to have that understanding of how it's going to be used.
Exactly.
Oh, absolutely. I think that's the starting point of any valuation.
Yeah.
Because if you do not have that clarity, very simply, you will not be able to deliver what the client asked you.
Yeah. Because the point of driving, Ameya, sorry for interrupting, is that most of us look at valuation as a desktop exercise. We have numbers, we put them together, we get some data researched and things like that. But in the case of evaluation of brand, probably you need to know something much more than that, much more than that. So I was just trying to get from your experience an assertion for the benefit of participants that valuation of brand is not just about desktop modeling, it's something much more than that.
Oh no, definitely not. Definitely, it's definitely not a desktop exercise, and a typical valuation exercises that we undertake can go anywhere between 3 and 4 months, if not longer.
So I think MPV,
go
MPV ahead. And I keep going back to this Kingfisher because it's very close to close in terms of number of years and stuff, and it had a value, and then the value eroded, and all of that. Did they manage to sell the Kingfisher brand in the recovery process?
No, I don't think so. See, that's the other.
Yeah. So I'm saying finally, is there a value? I mean, what I'm saying is that it was up for grabs in terms of loans. So somebody kind of hypothecated the brand, assuming that there is a value, and that would have been a scope of work for some valuer at some point in time. Yeah. I'm assuming that the value was X, and by the time you could have sold it for X minus 1, X minus 2, X minus 50, but suddenly there is no value attached to it. So the erosion of the so-called brand value, what we put a number to it, is also significantly faster than the erosion of any other value in the real world. That brings me back to that question: can you really put a number to a brand value? Or maybe if you have examples, Ameya, in the past, if some names would have sold simply for names, or brands would have sold simply for brands, so that all our viewers can appreciate the fact that yes, there can be a value attached to a name or whatever, a brand. Yeah.
Sure. So okay, on the point of value, attaching a value to a name, one thing, and I'm sure everybody understands this, but specifically when I speak to clients, the first point that I make is value is an opinion. Any value is an opinion. The only certainty is price. So unless somebody pays that price, you're never going to know. And this is true not just for brand valuation. Today you have stock market recommendations backed by analysts who say we think the intrinsic value of this stock is X or Y, but that's also an opinion. That's number one. So opinions can change. Opinions can differ based on the assumptions that the valuer makes. And that's why you see for the same brand, three people assigning a different brand value to it, right? And that number is assigned based on certain underlying assumptions that you make. So yes, you can assign a number. Two, that number is closely linked to the assumptions that you make. And three, in terms of erosion of brand value, you're right. Specifically in case of the Kingfisher brand, I am not sure what really was put up as collateral, whether it was the Kingfisher brand or whether it was the Kingfisher airline brand. And to my mind, that's where all the grays lie, because what was done was Kingfisher is a brand which was built by the beer, was suddenly applied to an airline. The airline died, and now you don't know what the ownership of the Kingfisher brand is. So the brewery part is not just going to give it up like that. They're going to say, I own this brand because it's my beer. So somebody probably at that time should have clarified this before, lending money against an intangible like a brand. First of all, that itself doesn't always happen. But even after that money was lent, probably these questions should have been asked at that point. Coming to your second point in terms of erosion, there is one case that comes to mind. You might have heard of this fashion brand called Net-a-Porter. Net-a-Porter is a fashion brand, and that was bought by Richemont. Richemont, as you know, is this holder of iconic brands. So every brands like Rolex, all of them are all part of Richemont. They bought it in 2010, and they sold it to another group in 2014, I think. And the deal was struck for about 950 odd million pounds. Now the minority shareholders said, we don't think this is fair value, you're shortchanging us. So they approached Interbrand, our UK office. They did a valuation for the brand, and they proved that the price that was paid for Net-a-Porter was much lower. So they were actually able to get I think 500 million pounds more, or something like that. So from 950
and this is just for the brand.
Just for the brand.
Fantastic.
Because
okay, I think this is the right time, MPV, to ask the question: how do you bloody value this here? So, do you use the same DCF method? Do you use the same Excel sheet? Right? Do you use the same risk weights? So yeah, back to you, MPV.
No, that's the same question. That's the very next question, actually. So, what are the methods for valuing brands? Right. How does somebody go about valuing a brand?
Right.
And just for the benefit of members, the Kingfisher one, my memory is it was the airlines brand which was valued, and it was for close to about 4,000 crores. And the way that brand was valued based on its ability to get that excess earnings as a premium product. And just like any asset gets impaired, Anil, I think this got impaired, that it no longer is a promise which people will trust, a Kingfisher airline brand. So that's how it gets impaired, and it's dead and gone forever.
No, not just that. It's also, to your point.
So I mean, just to this brand that you spoke about, Net-a-Porter. So for example, what I'm saying is Net-a-Porter. So what I'm saying is, they were able to associate a value which was different from the existing business. I mean, I'm saying the brand has come out of the business of whatever numbers that you're doing, and you're now attaching it to somebody else, right? And it still carries a value. So for example, a Kingfisher Airlines, for that matter, if I just take out the brand and would have attached it to maybe say any other airline, would it have carried value or not? And I mean, how do you make it stick? That was more of the question that I was coming from, and that was interesting that somebody got more than $1.25 billion for a brand $1.35 billion just for that brand to attach it to something. Yeah. Sorry, Amay, I think you were saying something.
Just on that point, I don't think we went back and said 500 million is the value of the brand. It doesn't happen like that, but because in the original deal for 950 million pounds, in the original deal, there would have been some assumptions for, I think the correct term is goodwill, which is what brand is a part of. We were able to prove that the amount that you had assigned for that goodwill portion should actually have been, the brand alone is worth so much, so it should have actually been about 500 million more. So that's how it was done. Because the other point to remember is that one can't really try as you might separate the brand from the business, because the business is necessary for the brand to deliver its promise. Were it not for the airline, how would Kingfisher deliver the promise? And yeah, it does deliver the promise.
So would it be fair to summarize our discussion to say that the brand value is closely associated with the business that it carries?
Yes,
right, in the real
absolutely.
world,
Absolutely.
world.
Absolutely.
And essentially what we're trying to value is that differential because of the name that you've created, that
Correct.
you're able to charge as a premium
Correct.
for the product that you're selling. Is that in summary what we're trying to achieve? Perfect.
That is
lovely. Right.
So
now how do you
methodology?
So how do we actually do this? Yeah, methodology. Correct.
So broadly, it depends upon the kind of data that's available. But you could use a profit-based method or a revenue-based method. The revenue-based method most commonly used is what is called a royalty rate relief, which basically looks at and we just right now finished a valuation for a precious metal brand, where because of the fact that they have so many stores and they could not accurately track sales data and profitability data more importantly than sales data. We said, okay, let's look for royalty rate relief method as the method of choice for valuing that brand. But Interbrand's traditional methodology is called the residual profit split method. So what that really entails is to look at the earnings, the profits that you have, and trying to estimate the proportion of that profit which can be attributed to the brand alone. And then using what you said, DCF, the way we define it is that brand value is the net present value of all your future branded earnings. That's one easy sentence. I mean, if I were to summarize it in one sentence, that's how I would do it. So typically you look at data from the last 5 years to see what your sales and profit trends have been. We look at then the projections that the company has made for the next 5 years in terms of revenues, in terms of profits, no PAT. See if it's making sense, because this is where you need to use some of your judgment, because end of the day, value is an opinion. So you're going to have to use some of your judgment as well. So for instance, if over the last 5 years, revenues have been growing at, let's say, 7%, 8%, and then all of a sudden in the next 5 years, the company is saying, I'm going to grow at 16% next year and 23% the year after. And then on, my growth is going to be a steady 18%. I'm going to go and question that, saying, what are you doing? Are you getting into a new market? If so, is it going to get profitable to that extent in year one itself? Why are you suddenly so optimistic? And then, I would probably make an adjustment based on what the past is, not take what the company is giving you or what the client is giving you at face value. And then I would get rid of, the entire capital charge, because you're interested in trying to figure what's the what's the profit that you're able to make, the economic profit, so to speak, only because of the brand. So come down to the economic profit, or some people call it economic value added. To that, I would apply the percentage of the role of brand. So again, role of brand, there are different ways to estimate it. You can do it judgmentally to say, okay, on an average, this particular brand sells at a slightly higher premium as compared to its competition. So so maybe if it's an auto brand, if the global average is 34%, this one may be at around 38%, 39%. So economic profit times the role of brand gives you what is called branded earnings, and you have it for the next 5 years. You have it for perpetuity as well, and then you apply the brand strength metric, and the brand strength really translates into a brand specific discount rate. So that's part of our proprietary method, where right from 100 to 10, every brand strength score comes up with a brand specific discount rate that you want to, that you should imply. So what that means is, if it is 50, then it's the average, and therefore that again translates to, you'll probably take the industry average WACC to do the discounting. But if it's, let's say, 80 or 90, then your discount rate is significantly lower. The assumption is stronger brand, therefore you can probably, your weighted average cost of capital would be lower as compared to a weaker brand. And then you start, then it's your basic DCF. So where you discount all.
But I understood the fact that a stronger brand would lead to some amount of value creation. I mean, saying expectation lowering in terms of lending rates and better rates on the market and all of that. But how do you actually value this? I mean, sorry, how do you actually put the brand as a strong, weak, or whatever? I mean, what goes into?
So great question. And what we do there is the brand strength analysis. So I'll go a little deeper into that. 1 second. Yeah. Well, for our entire brand strength framework, we look at basically 10 different factors. 4 of those factors are actually within the company. So they are what we call internal brand strength factors, and 6 of those factors are what we call external brand strength factors. So the internal brand strength factors would be things like direction. So are we clear as a company about who our competition is, who our customers are, what do they want, what does the brand stand for, what's the direction that we're going to take in the future with this brand. The second is alignment, which is, it's okay if the top layer understands, or if it's okay if everybody understands, and we're clear about what the brand is, but are we all pulling in the same direction? Or is customer service on its path, marketing on its path, and product on its path? So it's not just good enough to know what your brand stands for. The company needs to, or all parts of that company need to pull in the same direction. The third is empathy, which is how good are we at listening to our customers and their unspoken needs, and how do we respond to that? Are we leading the market, or are we following the market? And the fourth is agility. How quickly can we move? And in many of my interactions with clients, when you ask them, do you think you are responsive? And they say, of course we are responsive. We have this responsive culture in our company. And you ask them, give me an example of that. They say, my competition came up with that product, and we had ours in the market in less than 2 months. See how quickly we responded. We said, that's not responsiveness, that's reactiveness. And there's a difference. Responsiveness would mean you are leading the customer rather than or to put it another way, you're responsive to the competition, you're not responsive to the customer. If you were responsive to the customer, you would have been out with it first. So these are the 4 internal factors. And why we think they're important is because I think somebody in the beginning mentioned Michael Porter. Brands are no different. Unless you build a strong foundation within the organization, you have no hope in hell of building a strong brand outside. So the internal assessment looks at these 4 factors. The external assessment, on the other hand, is more customer and competition facing. So you assess how distinctive the brand is. There were points made of, how different is the promise. But distinctiveness goes beyond the promise alone. It could be distinctiveness in the way they interact with customers. It could be distinctiveness of the experience. Apple is a great example of that. At a product level, maybe Apple is not as great as some of its competition, whether it's a Samsung or any of the other Android phones. And there's always this fight, right? It says Apple has done this, Android has had it for the last 5 years. But the way Apple delivers that customer experience, it is right up there. No other experience is as distinctive, perhaps, as Apple's. So distinctiveness is one. Coherence is another important factor, because irrespective of which country, which channel you interact with the brand with, you expect a consistency of experience. So how coherent is your experience? Participation is the third factor. Is it a one-way message that I keep blaring from the rooftop that Coca-Cola is the real thing and you should be drinking that? Or are customers actually participating? Is it a two-way dialogue? And today's day and age, that becomes even more important, because, and we made this statement, I think 2 years ago, but in today's day and age, customers are using brands to build their own brand. We call it the age of you. So I use Nike shoes because I want to build myself as somebody who's performance oriented. Or I carry an Apple MacBook because I want to build my personal brand as someone who's creative. So when you put that in the backdrop, this participation becomes extremely important. You want a two-way conversation between the customer and the brand. The fourth external factor is what we call presence. And presence is not just about physical presence. It's also how top of mind are you in everyday conversations. Are people saying good things about you? Marketers call it the buzz. Is there a positive buzz around this brand? Like today, everybody talks electric vehicles. Look at the buzz that's surrounding Ola Electric, even before a single product that's come out there. So I see that as an example of a great amount of presence. And then there is trust. So that's the most basic. So do they trust this brand to deliver the experience that they're paying for? And finally, there's affinity. So do customers feel that this brand is playing a meaningful role in my life? Do I feel for this brand? So that's 10 factors.
Fantastic. I think, yeah.
Amay,
Go
that's a
ahead,
very
MP.
comprehensive explanation of what goes into the brand.
Yeah.
Given that we have an audience here who are all registered valuers, and almost all of them from an accounting background, can we spend a few minutes specifically to give guidance on the modeling to be followed for valuation? So you talked about economic value added, applying a brand multiple, etc. So can we give members a guidance on that piece?
And MPV, just before he dives deep into there, I just had a very quick one where all that Amaya spoke about, and which is perfect. I think those are the important elements and the foundations of how you create a brand. Is time element a very important element there? For example, all of these that you asked for, and there is a new brand which is emerging, which is just maybe a year old. And there is somebody who's been in the business for the last 10 years or 5 years. Is that brand's visibility and all of that would be, of course, more than a brand which is coming up, but otherwise there's enough engagement in the new brand. Does that play any role in terms of
Yes and no.
Yeah.
Yes and no
Okay.
is what I would say. Why I'm saying yes is because the longer a brand has existed, the stronger, the greater the chance that it could get stronger. However, the reason I say no is because in today's day and age, you will find brands that come and disrupt. I think somebody here spoke about disruption as well. So
True.
just that act of disruption can make that brand so much stronger because they've redefined the way the customer is looking at that particular industry. You know, electric vehicles, nobody even thought of it. But all of a sudden today, would I think Ola scooters or Ola Electric is a brand as strong as Bajaj? Probably yes, even without having a single product on the road. But the fact that they've completely changed the conversation, and Bajaj has been around what, 100 years, somewhere close to
True.
that.
True.
So yeah, that's why I said yes.
So fantastic.
And no.
So I think I'll put it back to MPV. Yeah, sorry MPV. I was just trying to figure out if there's a time essence value. Yeah.
That's a wonderful question, Anil, because there are use cases of both situations where time actually has made a difference to the value of the brand, and the cases where somebody has been hardly there for a year and it's a very powerful brand. We have seen both cases.
But to that point, we're talking brand strength here. It need not necessarily be brand value because the finances don't support it yet.
Correct.
So in terms of value, it still might be minuscule. Still, Ola might still be, a speck when compared to Bajaj. But what we're saying is in the future, it has that potential to scale up that value multiple times.
Correct. And probably with that 100,000 vehicles booking, probably the value would get attributed now. So
correct.
Yeah, fine.
Correct.
So let's get back. I think I have about 80 questions already for you from the participants.
Wow. Okay.
So from here, probably we'll move a little faster.
Sure, of course.
Just one question alone, little in detail, and thereafter we'll do a rapid fire. This one question, I just want to ensure that the participants are carrying with them a very tangible knowledge of when they sit across for doing an exercise of brand valuation. They are thinking that Ameya gave me this approach of start here, do this, get there. So I just want you to help us with that articulation.
Sure. So like I said, my first step would be to start with the last 5 years data and the next 5 years projection, let's say. And I would construct a spreadsheet like that, where you have T minus 1, 2, 3, 4, 5, and T plus 1, 2, 3, 4, 5, and then there's perpetuity, right? Then I would get down into each of the line items that probably appear on your P&L. So starting from revenues, getting down to the operating profit, and the lines between that, obviously the cost. Then getting rid of the taxes to arrive at NOPAT, the net operating profit after tax. Then getting rid of the capital charge. Now, typically the way we estimate capital charge is you look at, first of all, you will not have that data for the future. You'll only have that data for the past, right? So I would look at expressing the capital employed. Capital employed times the WACC that the company has, the existing WACC. Some companies have that data, some don't. Where you don't have it, you figure out industry averages. So the capital employed times WACC gives you that capital charge. And if I then look at that capital charge as a percentage of the revenue, I'm able to apply a capital charge for the future as well, because you don't have the capital employed data for the future. You don't know what's going to be. So look at it in terms of ratios. So what's your capital charge as a percentage of your revenue? You apply that to the future, and that's how you arrive at the economic profit, right? So that's the first step, this is the starting point of evaluation, which is the economic profit. To the economic profit, you apply a multiplier of the role of brand. Now, when we do it, we have, thanks to the thousands and thousands of hundreds of thousands of valuations we've done over the last 40 years, we have industry averages globally. So I know if I'm talking about, let's say, a sporting good brand, let's just say, I don't know, who are the guys in Ludhiana that make those bats? I think it's called BAT or something like that. I know that the global average roll-up brand for sporting goods is at about 46, I think it's 54% or something like that. And I would estimate that. So one is you can do that back of the envelope estimation based on global averages. But if the client has the time and the money, you can also do a very detailed market research on this, where you do paired comparison tests and you actually estimate based on statistical modeling what is the definite role of brand that this particular brand enjoys. So economic profit times role of brand gives you branded earnings. You now have it for the next 5 years. You also have a perpetuity value, which is usually the 50-year value, right? Then I would get into, so now I have branded earnings. Next, what I need to do is I have to zero in on a rate that I want to use to discount all the future to present. And to do that, I will do this brand strength exercise. The brand strength exercise gives the brand a number between 0 and 100, where 50 is the average. When you say 50 is average, it means your brand is as strong or as weak as the competition. And that corresponds to the industry average back rate. Any brand strength value above 50, the discount rate that I apply will actually start coming down. Yeah. So let's just say a brand strength of 58 gives me a discount rate of 11%. I will then apply that for the next 5 years to get the value through the forecast, and then I will apply that. What's that R minus? Of course, you also have assumptions that you make, which is on the long-term growth rate, because you'll need that to get the perpetuity value. The way we use long-term growth rate is the average GDP growth of India as a country over the last 20 years. That's what I would apply as a long-term growth rate. So you get two values, value through the forecast and the perpetuity value. The sum of that is actually the brand value.
Superb. Excellent, Amaya. Very, very helpful. In fact,
so just wanted to have a quick follow-on on the,
yeah.
Do you apply any value to, what is it called? I keep losing the term, meaning difficult to enter into a particular business, for example. I don't know, what's it called? Meaning to say that
the moat around the business?
Barrier.
Yeah, I mean, business barriers. So, it's very difficult for some new entrant to come in, right? Is that somewhere captured? Number one. Number two is, and again, of course, in the other light, is disruption happening in that industry also kind of, captured in all of this that you do, or it becomes a part of the normal valuation or not really the brand valuation?
So I believe that each of these would in some way be covered by one or more of the brand strength factors. So if it is disruption, for instance, it would reflect in distinctiveness, it would reflect in presence, it would reflect in participation, because anything disruptive is talked about. There is a lot of two-way communication. If it is a high degree or let's say an industry where there are high barriers, it would probably get reflected in something like the presence and the trust itself. So so that's how I would factor.
And where do you get these averages that you were mentioning for the purpose of for the benefit of everybody? Is there a database where you can get these average profitability or revenue percentages that one could charge because of the brand? Those averages are available, or those are more in-house that you have developed over a period of time?
Yeah. So the averages I was referring to is the average of the roll-up brand, which is something that we've developed thanks to doing so many exercises. So we now know that on an average globally, if it's an energy brand, it's about 18%.
Okay. All right.
But in terms of profitability, etc., I believe the client is the one who should be providing to us. do that comparison.
Amey, I just want to take a follow-on question from what Anil mentioned. I do appreciate that our global organization like Interbrand, 45 years of existence and having done so many valuations across the world, focused particularly on brand valuation. You have lots of historical data, industry-wise, size of entity, geography-wise, and things like that. But let's say for the valuers who are now listening to you, who are into valuation practice for last 3 years, last 5 years, and they get opportunities of valuing a brand. So is there some database which they can access or some kind of research they can carry on and arrive at some logical attribute to that brand role? Because that seems to be a very important one. Because NOPAT and arriving at economic value added is a understanding of the business and all that stuff. But that multiplier factor is a very critical number. And you don't have the luxury of erring on either side. You can't overvalue nor undervalue. You need to get there. So what is your guidance to lots of the young valuers who are listening to you as to how they should go about doing it? Of course, they will build their data over time, but I think we also need to support them with some access.
Absolutely. So I'm wondering if this data is available publicly. I'm not sure if our role of brand data is public. No, I don't think so. I'm just going through our site. It's not. And so unfortunately, I'll have to come back to you on this. I'll probably check if at all. If we can share the global averages, we'll be happy
or maybe
to do
even, maybe we could request you that Sarika could probably approach you formally from the institute, and you could probably help us to jointly prepare a paper, or maybe if you could even direct our members towards some industry reports which could bring it out. It will really help. Thank you. Back to you, MP.
So, Amey, the next question is: we have come across a few instances where people have got a brand valued, created an escrow, and have borrowed money. Of course, the trend has now shrunk thanks to one failure. But as a valuer, when you are doing a valuation exercise of a brand with a very clear objective that it will be mortgaged or pledged for the purpose of borrowing, are there any caveats which the valuer needs to highlight as part of the valuation report?
Yeah, absolutely. In fact, every valuation report that we put out has all those caveats. That is, in fact, part of the ISO 10668 standard that you're supposed to give a set of. You have to make it absolutely clear what your assumptions are, what is being valued, why it is being valued, what are your data sources, and how. So there are about 14 or 16 of those, and I can probably share that over an email. But to your question, and that's part of the ISO standard. Without that, your report is not ISO compliant.
Okay. So I have some of this.
Is there also any standards MPV across the world for brand valuation in any format?
Yes, there are two. One is called the ISO 10668 standard, 10668, which is the standard for monetary valuation. The other one, I forget what it is, but there are two standards.
Okay.
So typically, our reports go out to the 10668 standard.
In Indian context, Anil, we have the standard 302, which talks about intangible assets in general, which includes brand. We don't have a standard specifically for brand. We decided to build a guidance note. Probably we'll take the help of Amey.
That'll be really nice.
Now, coming to the next question, Amey, these are questions from the participants. What are the fundamental differences in brand valuation of a product versus brand valuation of organization. So what would be the difference?
I wouldn't say there is a difference at all, because what you so let me give you an example. If you looked at some of the league tables that Interbrand brings out, one is the best global brands, and you'll find a brand called Pampers in it. Okay, you'll find a brand called Gillette in it. And that really is an example of a brand valuation of a product brand, so to speak. Now, if you look at the other league table that we bring out in the local market, which is called Best Indian Brands, you'll find a brand like Reliance in it. You'll find a brand like Tata in it. That's not to say that, Tata is much more than a product brand. And the reason that happens is the lack of data. So when Reliance puts out its numbers, it doesn't expressly call out that Jio gave me so much of revenue, Reliance Trends gave me so much of revenue, so on and so forth. If that data was available, then that Reliance, that big behemoth, you would see 5 different product brands. And that again brings back the point that Anil, you were saying. How do you, like a Richemont, for instance, if I were to do a valuation of Richemont, it's always built bottom up. So each brand that it owns gets added. And that's why Tata is the largest brand in the country. Why? Because of TCS. Tomorrow, if TCS data is taken out and TCS is reported as a separate brand, Tata would no longer be there.
No, that's a very interesting one you said. We always thought that the TCS had a brand because of the Tata brand, and you're saying that the Tata has a brand because of the TCS brand. Of course, because TCS has gone global and it's every corner of the world, and it does carry the Tata name there.
That's right.
And it's a fantastic question. I'm not sure whether we have the time to debate that today. But MPV, what do you think? I think this is really fantastic. Yeah.
I've come across cases where subsidiaries have taken over parents.
Absolutely.
This is probably one such exception where one entity.
And I'm sure TCS must be paying a royalty for the Tata brand, if I'm not mistaken. And does that even make sense for the TCS? And does that even make sense for the TCS equity shareholders? I'm not sure about it, but I'm saying maybe we'll keep it for the other day.
Yeah.
I agree. So just plenty of questions from the participants, Ameya, and I'm sorry for making this request, but we'll try to see if we can do it as a rapid fire.
Sure, of course.
The question says movie stars, sports stars, they're all brand. They're also brand. How are they valued, and how do they insure themselves or their various body parts? And artists and professionals are also brands. So thoughts on that?
I would say it's very difficult to value person brands because for the simple reason that I will not be able to forecast what their earnings are going to be 5 years from now, and it has to have bearing in some truth. Movie stars, for instance, the way you go today, you've got a 100 crore film. Tomorrow you may be out. You never know. So I wouldn't go down that route.
Okay. And there is a question I haven't got much idea. It says Rolex rings being subscribed just because it Rolex in its name is probably a classic example of brand which impacts value.
Sure. Yeah, people they might have, but in the middle there was another example, I think, of a company which had some oxygen something in its name, and the stock went through the roof. It had nothing to do with oxygen. This was happening, in the middle of the second wave.
Yeah, they are
it's the same thing.
Imperfections. So the brand value of MRF is derived from tires or the international cricket bat, which has made the brand even more popular.
No, it's tires. It'll only be tires. The cricket bat is adding to presence in the MRF brand.
Okay. In case of old brands which are not financially generating income, how that has to be valued? For example, Keventers.
Which one? Sorry?
Keventers. Well, participant.
Okay. No, I would say if there is no financial profit being generated, then there is no value that you can attribute. In fact, I've turned down valuation requests. Some of these startups
is name recall in the market, and then you can use that to associate it with something or create a similar product, not carry a value of any sort?
I'm sure it does. I'm sure
because somebody would have
but
spent billions of dollars trying to generate something,
absolutely.
and of course the business could have gone down, right?
So if you're able to prove that at the heyday, this is the kind of value I was generating. But like I said in the beginning, value is an estimation.
You wouldn't want to attach too much of a value, but what you're saying, there could be a residual value.
Yeah.
I mean, to summarize what you're saying.
Absolutely, there would be a residue. Yes.
Actually, one of the participants has given the name of that company, oxygen company, Bombay Oxygen.
Yeah, Bombay Oxygen. That's right.
So the other question is, if brand has economic value, why is it valued only in specific situations? Should it be not part of routine financial reporting?
It should be. I strongly believe it should be. And there are some progressive companies that disclose this in their notes to say, while we've not included this in our financial reports in the balance sheet, but this is the value.
So there's a question on, does the purpose of valuation have an effect on the valuation of the brand?
Not really. I wouldn't. I don't think. Oh, but I think MPV, that brings us to the question again about the scope of the valuation. And what I've learned in the last 6 weeks, MPV, is that the scope of the valuation has an impact on the valuation, right? I'm saying from a numbers perspective, if Ameya was valuing a brand, which was, yes, from a numbers perspective. So for example, if you were valuing a brand which somebody wanted to hypothecate and take a loan against, you would value it at an X value, being conservative or whatever. And if you were to value it from an M&A activity, it could carry a different value. So what I've understood of all the valuations in the last several weeks that we discussed,
it'll always be a range.
Absolutely. I think. So in fact, our standards, Ameya, in the institute actually allow you to actually give a range. And you're right, it should fall within the range, though. It cannot be completely different from the range. Okay, cool.
Yes.
So there's other question, whether generalization of a brand is a good thing for the brand.
I don't understand what the person means by generalization of a brand, but if the idea is that you make it applicable everywhere, then I'm not so sure it's good, because a brand derives a lot of its value from how distinctive it is.
Okay. Tata took over Jaguar, but retained and continued to market the product as JLR, but not as Tata. What was the reason?
Yes. That was a legal reason. It was there in the contract.
Okay. So Microsoft bought Nokia, and that deal was not much successful, neither for them, since Microsoft was not able to make a successful deal, and Nokia lost faith of the people. How do you see it from perspective of brand valuation as to where it went wrong?
I think Nokia is a classic case of, if I were to look at it in terms of the brand strength, it is a classic case of zero agility. It just didn't see the change in the market coming. And overnight, incidentally, Nokia, if you went back to Interbrand's best global brands league table, and if you went, let's say 10 years ago, you'll find Nokia amongst the top 10 brands.
Top, absolutely. It was almost in the top 5 or whatever.
It's just that they fell asleep at the wheel. They didn't change.
Kodak, and that was in some way true for BlackBerry as well, right? And in the sense that BlackBerry, they had some fantastic products, but
correct. They just did not see the tide turning, and the same for Kodak, for that matter. I don't know how many of us even remember Kodak film, but there you go.
Okay. Absolutely. So Hindustan Lever bought over Dollops ice cream from Cadbury's, just to destroy the brand of Dollops. Hindustan Lever was having quality ice cream brand, and Dollops was only in Mumbai. In such situation, brand value is to be evaluated from the buyer's business perspective or the seller's business perspective.
It depends. I'd say it depends on whose side you're in. If you're on the buy, if the buyer has asked you to do the valuation, you would look at it from the buyer's perspective, isn't it? But
Okay.
if on the other hand, it's the
It's
seller
also
that's
interesting, MPV. Even if you want to kill a brand, and if it's going to add a substantial value to your brand or your product, maybe the value of the brand that you want to kill could be higher than, of course, what you're perceiving it to have, right? Maybe when a Coke bought a Thumbs Up over, they thought that the value was pretty good, but they didn't kill Thumbs Up because they realized that the value of the Thumbs Up brand was absolutely sticking in the minds of the people, right? So yeah, I think going back to scope there. All right.
Can a brand be valued at the time of merger as an intangible asset, and how does it differ from goodwill at the time of merger?
well, I would say a brand is a subset of goodwill because in the balance sheet, that's where it would sit. By valuing the brand, you're just pulling that bit out and saying, if 100 is your goodwill, 37 is because of the brand, and the other is other intangibles, let's say.
Okay. There's a other question. Probably I'll keep this last question, or I don't know whether this is an observation of this participant. Hindustan Lever was ready to buy brands from Tomco due to competition from Nirma, but Tomco did not allow to merge the company and valued the share at 65 or so, which is much more less than brand value because Tomco had fewer brands in number, 1 to 5 in South Africa, where Hindustan Lever has business. Hindustan Lever paid brand value to save its market share, as HLL cannot sell low quality in the Surf brand. I'm not sure whether it's an observation or the participant is seeking a response.
No, I think I think he's just trying to engage to say that this is what had happened from a brand perspective. Yeah.
And see, just a couple of last questions.
Sure.
Then I'll leave it to Anil to summarize. See, how can a valuer identify whether there is a brand or not? First of all, how does somebody identify that there's a brand existing or not? What factors should be kept in mind, or what are the attributes which will tell you that yes, there is a brand? Because brand not necessarily mean a logo, need not necessarily, it can be something else as well. So how does somebody identify, yes, that there is a brand in this organization?
Well, very simply, it would be how the business goes to market. So if I'm making toothpaste, there is something on the toothpaste, right? And that becomes the brand. I don't think any business will go to market without a name at the bare minimum. Forget the logo and the colors and all of that. But even if it's a plain and simple white carton with the name Anil written on it, then it's Anil as the brand that I would use. So like I mentioned at the beginning, if you look at brands as interfaces between the customer and the business, that should give you a clue as to what can be considered a brand, what cannot. So every interface. So and I think it was Michael Eisner that said it, the ex-CEO of Disney. It's a living. He said a brand is a living business asset, and it can either be enriched or killed every day by the product of 1,000 small gestures. So how your people interact with the customers, let's say at a sales call, what benefits your product gives you, what environments, how your showrooms look, it's all part of the brand because it is the interface between the business and the customer.
So last question, Ameya. We come across instances where there are multiple entities, let's say a group of companies, multiple entities who are involved in the development and use of the brand. So I have 10 group companies, one of them is in chemical, one of in steel. Yeah. All of us are doing this business over a period of time and a common name emerges.
Yes.
So in those cases, how is a brand, when I want to do a valuation for an entity. So how do I value a brand in such cases?
So the brand itself would be valued as a whole, and depending upon the ownership of them, so which is why it becomes extremely important to actually define the ownership of a brand very, very clearly. And I'll come to that in a minute. But in this case, I would say, depending upon the degree to which each of the entity has contributed in creating that brand, that's how I would do it. But in what I would keep at the basic, at the bare base level, is how does that brand go to market? So is it actually going to market based on the products that each of the entities make, or is it an entirely different? So give you an example, Tata, right? Tata makes cars, Tata makes steel, Tata has all these services. So each of these are valued separately, and the aggregate of that is the value of the Tata brand. Whereas you could have, let's just say, let's take another example of Reliance. Okay, Reliance probably makes polyester pellets, which then makes which then gets woven into a yarn, which then becomes a sari, which is sold under the Vimal brand. Now, I cannot say that the Vimal brand can be attributed to the polyester pellets, because that's not how the customer is interacting. Why I said uh, uh, it's important to establish ownership is because traditionally, if you look at Indian companies, they've gone into business under a common name, and very often it's been a family name. Then the families have grown, and with every generation, there is a bit more distance, and therefore we're seeing a lot of cases where someone would come to you and say, can you value this brand? Because we had a family agreement and now we want to split. And when you ask them, you realize that the agreement never specified the use of brand. Never. The recent example, if you've been seeing, of the new Kirloskar brand, that also resulted from a similar thing, right? Because Kirloskar is a family name, was being used by 4 different businesses, 4 brothers, who ran their own business until one of them said, you know what, I'm going to create a different Kirloskar, which is owned only by me.
Yeah, actually, that also brings to an interesting point. Sorry for stretching this, Anil. If you take in South, we have this company called Muthoot.
Yeah, I know. I've heard of
There's a blue Muthoot, there's a green Muthoot.
Yeah, Haldiram.
How do you value those?
If you look at Haldiram in Delhi, it's red. But if you looked at Haldiram in Bangalore, it's yellow, and Haldiram in Calcutta is green. Part of the original, 3 different brothers, and they have, I think, have the understanding that I will only use this brand in this territory. So it's a tough one, and I think businesses are going to have to bite this bullet.
But I think one very important takeaway I'm seeing, Ameya, and I will, wherever I get opportunity, I'll share this, is that there is a need for businesses and owners, promoters, to take steps towards establishing a legal ownership of brand.
Absolutely.
So that it becomes a more valuable one and becomes a structured one for succession planning. I think that's a very important takeaway personally for me, even though I've been on the subject for quite some time. To be honest, it struck me only when you mentioned the last, that I think we should guide businesses to, at appropriate time, to ensure there's a legal right established, documented for a brand. Thank you for that insights. It was a pleasure interacting with you, Ameya. And over to you, Anil, for the concluding remarks.
Well, thank you, MPV. I think as always, I think our sessions have been very engaging and interesting. And today, I think this was a slight turn from where we normally do in terms of, accounting and auditing and getting into numbers. And it is to do with brand and customer and a consumer engagement, which, chartered accountants are so away from. And I'm really glad that, we have Ameya here and he was able to, put this very nicely. So couple of things that I would like to take away from this session. One, of course, is an interesting fact that and with a name, for example, like a Tata brand is bigger or a TCS brand is bigger. So it brings us into an age where I think the differentiators have started to become different, and also the value of the brand and the time to market and the disruptions playing a amazing role. So all of those would make it more complex in the future for one to do. But I think the two inputs that I'm sure which has come out very clearly from Amay's discussion, one is, of course, the averages of the brand that you could attribute to profitability, which I believe is likely to be very important for our valuers to understand that, to get into the nitty-gritties, to be able to arrive at reasonable valuation, fair valuation, as you may want to call it. And the second part is to try and evolve a methodology to come to a fact whether this brand is really strong, weak, high, medium, low, whatever, right? So that these two play a very, very, I would say, a dominant role in terms of brand valuation. And the fourth one, which I believe is even more important, and MPV, if you remember, last time you said that valuation is now likely to become a specialized subject, not only industry, but what I learned today is valuation even verticalized, right? A brand valuation and specialization around it, and interbrand able to establish the brand valuation specialty across the world is also a fantastic opportunity for some of our valuers. So I think all in all, substance, I think I had a great learning experience today. Thank you, Amay, for putting this together very, very nicely for all of us. And at least I did get a good sense of the fundamentals which get into brand valuation. I would only encourage Sarika to actually reach out to Amay and maybe help our members to either get them in the right direction. And if Amay is able to work with his organization and the ICAI, maybe we could try and have a joint document around a thought leadership document around averages or whatever, and maybe a guidance note around brand valuation. That would be a fantastic value add for all our members, because I'm sure while Amay and his organization do some fantastic work for large and small brands, there are so many brands which are likely to hit the market in the next couple of years because of all the tech and the digital revolution which is happening. This would become a very important subject for, I think, all of us. So thank you once again, Amay. I think I would let Sarika do the formal honors, but I think it has been a very meaningful and engaging session, at least for me. Thank you.
Thank you, sir. Adding on to the words of Anil Bhandari, sir, different perspective from the point of view of Haldirams having different colors in different places. We never noticed it, but this is for the first time we could notice this different colors in different places for Haldirams. So that is how the brand has to be valued, not as Haldirams, but Haldirams also green, red, and green and red color. Yeah. So this is something different. And second, or one more point is, we have been learning experience of chartered accountant valuers. So this is something very different from having a person who is not an MBA, who is not a chartered accountant, who is not a finance professional. So the experience, and specifically on the topic of brand, we have learned.
And interestingly playing a pivotal role in valuation and not being a finance professional. Yeah. So fantastic.
Exactly.
Yeah. Sorry. Yeah.
Like neither being chartered accountant, cost accountant, company secretary, MBA in finance, or architect, engineer. So it was something different, very different, and articulation was so well. We have with us approximately 2,500 valuers who are now watching us, and we have received hundreds of questions. Though different questions and very differently we have questions. Thank you so much for being with us and accepting our invitation. We came in touch with you after 6 years. I had a doubt whether you will accept it or not. It is a different format other than presentation. So accepting this kind of format for not being a finance professional was also like we are thankful to you, sir. Bhandari sir, thank you as usual. MPV sir, Rakesh Sehgal sir, and thank you all the viewers. Next week we have due diligence and valuation, and kindly note that timing for the next week, only for the next week, is 12 to 2. All of the other weeks we have 11 to 1. Specifically for 8th August, timing is 12 to 2. And topic is due diligence and valuation. Thank you so much for being with us, for watching us. This is 11th week, and we proposed to do it for weeks together. It is now proposed for 30
Sundays
weeks.
with valuation experts is likely to be a brand, Amaya. So maybe we'll come back to you for valuation.
Yeah, we can value it, absolutely.
Yeah. Thank you, all of you, for being patient with us. Thank you, Amaya sir, once again. For
Thank you. It was a pleasure to be here.
articulating so
Happy
well and
28th,
putting your
all.
thoughts so well. Thank you so much,
Thank
sir.
you. Thank you, everybody. See you next Sunday. Bye-bye.
Have a good weekend. Bye.
Thank you. Bye.